3 countries, 3 different centuries, 3 catastrophic economic collapses: Argentina in 2001, Greece in 2010, the Ottoman Empire in the 1870s, separated by geography, culture, and time. But when you examine how each economy destroyed itself, the pattern is identical. Same structural weaknesses, same policy mistakes, same inevitable progression from prosperity to ruin. And the same pattern is building again right now in economies you think are stable. This isn't coincidence. It's not bad luck or unique circumstances. It's a recognizable sequence that plays out when governments make specific choices about debt, currency, and fiscal discipline. Once the pattern starts, it becomes almost impossible to stop. The mechanism is predictable. The timeline varies, but the outcome is always the same: economic collapse, social chaos, and wealth destruction on a massive scale. Understanding this pattern matters because it's not historical curiosity. It's early warning. When you see these structural features forming, you're watching the early stages of collapse. The countries experiencing it always deny the similarities. They insist their situation is different, their economy is stronger, their leadership is smarter. They're always wrong. The pattern doesn't care about exceptionalism, it just executes. This is the story of how 3 economies at different times and places followed the same path to destruction. How each made choices that seemed rational in isolation but created systemic fragility. How debt spirals, currency crises, and social breakdown follow a predictable sequence once certain thresholds are crossed. And how the same structural weaknesses are present today in major economies that believe they're immune because they haven't collapsed yet. The Ottoman Empire in the 1870s was one of the world's great powers, controlling territory from Eastern Europe to the Middle East and North Africa. The empire had survived for over 500 years. It controlled trade routes, commanded armies, and influenced global politics. But beneath the imperial facade, the Ottoman economy was rotting from debt accumulation and structural imbalances that would trigger the first modern sovereign debt crisis. The problems began with modernization. The Ottoman leadership recognized the empire was falling behind European powers militarily and economically. The solution seemed obvious: borrow from European banks to fund infrastructure, military upgrades, and administrative reforms. The Tanzimat reforms of the 1850s and 1860s required enormous capital. Railways needed to be built. The military needed modern weapons. The bureaucracy needed to be professionalized. European banks were eager to lend. Ottoman bonds paid high interest rates, often 8 to 9%, compared to European government bonds paying 3 to 4%. The lending seemed safe because the Ottoman Empire was vast and had been stable for centuries. Surely an empire that old and that large couldn't fail to repay. The assumption was catastrophically wrong. Ottoman borrowing accelerated through the 1860s and early 1870s. By 1875, the empire owed European creditors approximately £200 million, roughly $15 billion in today's terms. More importantly, debt service consumed over half of government revenue. The empire was spending more paying interest on old debt than on its military, administration, or infrastructure combined. The mathematics were brutal. The empire's annual revenue was about £20 million. Debt service required £11 million. That left only £9 million for everything else: the army, the navy, the bureaucracy, infrastructure maintenance, and all other government functions. The empire was bankrupt in everything but name. Ottoman officials understood the problem but faced impossible choices. They could default immediately, which would trigger European military intervention and possible dismemberment of the empire. Or they could continue borrowing at increasingly punitive rates, hoping economic growth or political reform would eventually make the debt sustainable. They chose to keep borrowing, making the eventual collapse worse. The new loans came with conditions that worsened Ottoman fiscal position. European banks demanded shorter maturities, higher interest rates, and direct control over revenue streams as collateral. Some loans required the Ottoman government to pledge specific tax revenues as security. This meant the empire was pre-committing future income to debt service before the money was even collected. The debt spiral was in motion. To pay interest on existing debt, the empire borrowed more. Each new loan carried higher interest rates because lenders recognized the mounting risk. Ottoman bonds that paid 8% in 1870 were paying 12 to 14% by 1875. But the empire had no choice. Defaulting meant losing access to capital markets entirely and facing European military intervention to protect creditor interests. So the borrowing continued, making the situation worse with each transaction. In 1875, the Ottoman government tried to restructure. It announced it would pay only half of the interest due on its bonds. Bondholders predictably panicked. Ottoman bonds collapsed in value. New lending stopped entirely. Without access to new loans, the empire couldn't pay even the reduced interest it had promised. In 1876, the Ottoman Empire declared bankruptcy, the first major sovereign default of the modern era. The consequences were devastating. European powers, led by Britain and France, established the Ottoman Public Debt Administration, a foreign-controlled entity that took direct control of Ottoman tax revenues to ensure debt repayment. Specific revenue streams, taxes on salt, tobacco, alcohol, stamps, and silk, were assigned directly to European creditors. The Ottoman government collected these taxes but couldn't spend the money. It went straight to foreign bondholders. This was financial colonization without military conquest. The Ottoman Empire remained nominally sovereign, but its finances were controlled by European creditors. The government couldn't invest in development or defense because revenues went to debt service. The empire's ability to modernize or compete militarily was crippled. This financial subjugation contributed directly to the empire's complete collapse after World War I. The pattern was established: borrow to modernize, accumulate unsustainable debt, lose fiscal sovereignty to creditors, collapse economically and eventually politically. This exact pattern would repeat in Argentina and Greece over a century later. Argentina in the late 20th century was wealthy. The country had abundant natural resources, educated population, and strong agricultural exports. In the 1990s, Argentina was celebrated as an economic success story. It had tamed hyperinflation through radical currency reform, pegging the peso to the US dollar at a 1-to-1 exchange rate. Foreign investment poured in, the economy grew, privatization and market reforms were praised by international institutions. But beneath the surface, the same structural problems that destroyed the Ottomans were building. The currency peg that stopped inflation also created rigidity. When the Argentine economy needed to adjust to changing conditions, it couldn't devalue the currency to regain competitiveness. Instead, pressure built up in the form of rising government debt and deteriorating trade balances. The Argentine government borrowed heavily during the 1990s boom. Debt seemed manageable when the economy was growing and foreign investment was flowing in. But the peso's peg to the dollar meant Argentine exports became expensive when the dollar strengthened. By the late 1990s, Argentina was losing competitiveness against Brazil and other trading partners. Exports fell, economic growth slowed, government revenue declined while spending remained high. The debt spiral accelerated. Argentina borrowed to cover budget deficits caused by falling revenue. By 2001, Argentina owed over $140 billion. More than the country's entire annual economic output. Debt service consumed massive portions of the budget. The government tried austerity measures, cutting spending, raising taxes. But these made the recession worse, which reduced revenue further, requiring more borrowing. The currency peg became a trap. Maintaining it required massive foreign currency reserves to defend the fixed exchange rate. As investors lost confidence, they pulled money out of Argentina. The central bank had to spend reserves defending the peso. When reserves ran low, the choice was stark: abandon the peg and watch the currency collapse, or maintain the peg and run out of reserves entirely. In December 2001, the Argentine government froze bank deposits, the Corralito. Citizens couldn't access their own money. The measure was supposed to prevent bank runs and capital flight. Instead, it triggered riots. The government collapsed. Argentina defaulted on $93 billion in debt, the largest sovereign default in history at that time. The peso peg was abandoned. The currency collapsed, losing 75% of its value in months. The Corralito details reveal the desperation. The government limited withdrawals to 250 pesos per week, barely enough for basic necessities. People couldn't pay rent, buy medicine, or access their life savings. Businesses couldn't pay suppliers or employees. The entire economy ground to a halt because money was trapped in the banking system. The social explosion was immediate. Protests erupted across Buenos Aires. Middle-class Argentines, people who had played by the rules, saved money, and trusted the system, found themselves locked out of their own accounts. The cacerolazos protests, where people banged pots and pans, became the symbol of popular rage. Clashes with police turned violent. Supermarkets were looted. At least 27 people died in the riots. President Fernando de la Rúa resigned and fled the presidential palace by helicopter as protesters surrounded the building. Argentina had 5 different presidents in 2 weeks. Each promised to solve the crisis. None could. The political system had lost all legitimacy because it had betrayed the basic social contract: protect people's property and savings. When the peso peg finally broke, the currency didn't just decline, it collapsed. The peso went from 1 to 1 with the dollar to nearly 4 to 1 within months. Anyone holding pesos saw 75% of their wealth evaporate. Imports became unaffordable. Inflation surged. Real wages collapsed. The economy contracted 20% in a single year. The social consequences were catastrophic. Unemployment exceeded 20%. Poverty rates double. The middle class saw their savings evaporated. Political instability led to 5 presidents in 2 weeks. Argentina went from being praised as a model reformer to a cautionary tale of economic collapse. And the pattern that destroyed the Ottomans had repeated exactly. Unsustainable debt accumulation, loss of fiscal flexibility, attempts at austerity that worsened the crisis, default, and social breakdown. Greece in 2010 followed the same script with eerie precision. After joining the Eurozone in 2001, Greece borrowed at low interest rates previously unavailable because investors assumed the euro made Greek debt as safe as German debt. The assumption was wrong, but it lasted long enough for Greece to accumulate catastrophic debt levels. Greek government spending surged through the 2000s. Public sector wages increased. Pensions became more generous. Tax collection remained weak. The government borrowed to fund the gap between spending and revenue. By 2009, Greece's budget deficit was nearly 16% of GDP, one of the highest in the developed world. Government debt exceeded 120% of GDP and rising. The 2008 financial crisis exposed the fragility. Investors suddenly focused on government debt sustainability. They realized Greek finances were unsustainable. Borrowing costs spiked. Greece found itself in the same trap as the Ottomans and Argentina, needing to borrow to service existing debt, but facing prohibitively expensive borrowing costs. The European Union and IMF intervened with bailout packages totaling over 300 billion euros. But the money came with conditions, severe austerity measures. Greece had to cut government spending, raise taxes, reduce pensions, fire public employees. The measures were supposed to restore fiscal sustainability and confidence. Instead, they triggered a depression. Greek GDP contracted by over 25% between 2008 and 2016, a decline comparable to the U.S. Great Depression. Unemployment exceeded 27%. Youth unemployment reached nearly 60%. Poverty increased dramatically. The social fabric frayed. Political extremism surged. Greece received financial assistance but lost fiscal sovereignty, just like the Ottomans. EU and IMF officials effectively controlled Greek economic policy. The Greek debt crisis persists today. Despite multiple restructurings and bailouts, Greek debt remains above 170% of GDP. The economy has stabilized but not recovered. The pattern played out again: unsustainable debt accumulation, loss of economic flexibility, austerity that worsened the crisis, external creditors controlling domestic policy, and prolonged economic and social damage. When the London gold pool closed in March 1968, there was no warning. Investors woke up and the market was locked. No gold available, no conversion, done. We created the 7-stage collapse survival guide so you never get trapped when the window closes. It shows you exactly when to move your wealth into assets that survive collapse, before banks freeze, before governments confiscate, before inflation devours your savings, while you can still act. The pattern across all 3 cases is clear and replicable. It starts with borrowing that seems manageable. Government debt funds, infrastructure, military, public services. investments that seem productive. Interest rates are reasonable. Economic growth makes debt service affordable. This phase can last years or even decades. The accumulation is gradual, so it doesn't trigger alarm. The borrowing accelerates when conditions change. A shock, financial crisis, war, commodity price collapse reduces government revenue or increases spending needs. The government borrows more to maintain services and avoid painful cuts. Debt grows faster than the economy. Debt to GDP ratios cross critical thresholds. Investors begin to worry about sustainability. The debt spiral kicks in. Borrowing costs increase as investors demand higher interest rates to compensate for mounting risk. The government must borrow not just to fund deficits, but to pay interest on existing debt. Each new loan makes the situation worse because it adds to the debt stock requiring future interest payments. The trajectory becomes unsustainable, but stopping seems impossible. Austerity attempts fail. Governments try to cut spending and raise taxes to reduce deficits and restore investor confidence. But austerity in a weak economy reduces growth further, which lowers tax revenue, which requires more austerity. The debt to GDP ratio worsens despite spending cuts because GDP contracts faster than debt decreases. Austerity becomes self-defeating. The crisis breaks. Investors refuse to lend at any price. The government can't roll over maturing debt. Default becomes inevitable. Currency collapse often accompanies sovereign default. Economic activity contracts sharply. Unemployment surges. Social unrest follows. Political systems become unstable. External creditors, whether European banks in the 1870s, the IMF in 2001, or the EU in 2010, impose conditions in exchange for emergency funding. The aftermath is prolonged economic damage. Even after default or bailout, recovery takes years or decades. Trust in institutions erodes. Human capital deteriorates as educated workers emigrate. Investment collapses and recovers slowly. The countries emerge poorer, politically fractured, and scarred by the experience. The structural factors that enable this pattern are identifiable in advance. High government debt relative to GDP. Budget deficits that persist even during economic expansions. Weak tax collection, large public sectors, inflexible economies that can't adjust quickly to shocks. Currency pegs or membership in currency unions that prevent monetary policy adjustment. Over-reliance on foreign borrowing. Political systems that reward short-term spending over long-term fiscal discipline. When these factors combine, the pattern becomes almost inevitable. The timing is uncertain. The unsustainable can persist longer than seems possible. But once the pattern is established, the outcome is predictable. The specific trigger varies: a financial crisis, a commodity shock, a change in investor sentiment. But the progression from unsustainable debt to default follows the same sequence. Current examples are emerging. Japan has government debt exceeding 250% of GDP, but hasn't faced a crisis because borrowing is domestic and in yen. The Bank of Japan owns over half of all Japanese government bonds, effectively monetizing the debt. Interest rates are kept near zero through massive central bank intervention. Japan's situation seems stable until it suddenly isn't. The demographic collapse means fewer workers supporting more retirees, which makes the fiscal situation progressively worse. Japan believes it's different because its debt is owed to itself. The Ottoman Empire also owed much of its early debt domestically before external borrowing became necessary. Italy has debt above 150% of GDP within the Eurozone, unable to devalue and dependent on European central bank support. Italian bond yields periodically spike when investors worry about sustainability, forcing ECB intervention. Italy can't print euros to inflate away debt. It can't devalue to regain competitiveness. It's trapped in the same way Argentina was trapped by the peso peg. The only thing preventing Italian crisis is ECB's implicit promise to buy unlimited Italian bonds if necessary. But this creates moral hazard and perpetuates fiscal indiscipline. Several emerging markets are accumulating dollar-denominated debt that becomes unsustainable when the dollar strengthens. Turkey, for example, has massive corporate dollar debt. When the lira weakens, the real burden of dollar debt increases. This creates balance sheet crises for Turkish companies and banks. The pattern mirrors the Ottoman Empire's European debt becoming unpayable as Ottoman revenue fell. The United States has federal debt exceeding 100% of GDP and rising, with massive unfunded entitlement obligations. Social Security and Medicare have unfunded liabilities exceeding $100 trillion over the next 75 years. The fiscal path is unsustainable under any realistic assumptions about economic growth and tax revenue. The U.S. claims reserve currency status makes its debt special, that global demand for dollars and treasury bonds means the U.S. can borrow indefinitely without consequence. This American exceptionalism argument ignores history. Britain had reserve currency status with the pound sterling. The British pound was the global reserve currency for over a century. Britain accumulated massive debts financing World Wars I and II. The reserve currency status didn't prevent Britain from being forced to devalue the pound multiple times and ultimately losing reserve currency status to the dollar. Reserve currency status is consequence of fiscal strength, not cause. When fiscal position deteriorates enough, reserve currency status erodes. These economies insist they're different. Japan says its debt is sustainable because it's held domestically. Italy points to its membership in the Eurozone. The United States claims reserve currency status makes its debt special. These rationalizations are similar to what the Ottomans, Argentina, and Greece said before their crises. The pattern suggests these differences delay the crisis but don't prevent it. The policy responses are predictable too. When crisis threatens, governments first deny the problem exists. When denial fails, they promise reforms that are never fully implemented. When borrowing costs rise, they accept emergency funding with conditions from external creditors. When social unrest erupts, they blame external forces rather than their own policy failures. This political pattern accompanies the economic pattern in every case. The human cost is enormous and often forgotten in economic discussions. In the Ottoman Empire, financial collapse contributed to famine, social breakdown, and eventual dismemberment of the empire after World War I. In Argentina, the 2001 crisis created a lost generation. People who saw their savings destroyed, couldn't find work, and emigrated or descended into poverty. In Greece, suicide rates increased, families were destroyed by unemployment, and young people abandoned hope of prosperity in their own country. These aren't just statistics, their lives ruined by economic policy failures. The pattern isn't abstract. It's the mechanism through which governments destroy their citizens' futures through fiscal irresponsibility. Understanding the pattern matters because it creates the possibility of avoiding it. But avoidance requires political will to make unpopular decisions before crisis forces them. That political will rarely exists. The pattern persists because the incentives are perverse. Politicians benefit from spending and borrowing today while pushing costs onto future governments. Voters reward immediate benefits and punish necessary austerity. Financial markets lend readily during booms and panic during busts. International institutions provide bailouts that prevent complete collapse but also prevent necessary reforms. The system perpetuates itself until external crisis forces change. The lesson from the Ottoman Empire, Argentina, and Greece is clear. Unsustainable debt doesn't become sustainable through denial or clever financial engineering. Eventually, mathematics asserts itself. When debt service consumes too much of revenue, when borrowing can only be funded at prohibitive rates, when investors lose confidence, the pattern reaches its inevitable conclusion. Default, currency collapse, depression, and social breakdown follow. You can see the pattern forming in real time if you know what to look for. Rising debt to GDP ratios, budget deficits during economic expansions, increasing reliance on foreign creditors. Political paralysis preventing fiscal reform, central banks monetizing government debt to suppress borrowing costs, widening spreads between government bond yields and benchmark rates, capital flight by wealthy individuals and corporations. These are the warning signs. The countries currently exhibiting multiple warning signs include several that consider themselves immune because they haven't experienced crisis yet. This is the final phase of the pattern before it breaks, the conviction that this time is different, even as every structural indicator suggests similarity to past collapses. The Ottoman officials borrowing in the 1870s didn't think they'd default. Argentine policymakers in the 1990s believed the peso peg was permanent. Greek governments in the 2000s thought the Eurozone made them safe. They were all wrong. The pattern is a warning system. When you see these structural factors combining unsustainable debt accumulation, fiscal indiscipline, currency inflexibility, external borrowing dependence, you're watching the early stages of the same pattern that destroyed the Ottoman Empire, Argentina, and Greece. The timeline is unknowable. The outcome isn't. Once established, the pattern executes with mechanical inevitability. The only variable is how long the unsustainable persists before it collapses. The three countries, separated by a century and continents, followed identical paths because the economic mechanisms are universal. Debt mathematics don't change based on culture or geography. When governments spend more than they collect, borrow to cover the gap, and service debt with more borrowing, the trajectory is set. The specific trigger that breaks the system varies, but the progression from unsustainable accumulation to inevitable collapse is predictable once you recognize the pattern. This is decoded economics. Subscribe to see the collapse before it happens.